Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. My guest today is Kathleen Smith, Chairman and Co-founder of Renaissance Capital, a global IPO investment advisory firm. They also manage 2 IPO ETFs. We're talking about the IPO market today and the IPO ETFs. Welcome back on the program, Kathy.
Thank you, Nina.
So we spoke earlier this year in March, in fact, and this was expected to be a bumper year for IPOs. And in fact, IPO market was quite hot earlier this year, but now it has cooled off, and it seems that investors have lost appetite for these loss-making unicorns that do not have a clear path to profitability and founders that have, outsized control. We saw the shares of Smile Direct Club, which started trading last month, fall 28% on the first day of trading. Peloton shares closed more than 11% down in their debut. So before we discuss the reasons for, kind of failure, I wanted you to give us an overview of the IPO market so far this year. How many companies have gone public? How many of them were unicorns? And what was the amount raised?
Sure. And these statistics may surprise you. It kind of covers up there's a storyline underneath the IPO market that we'll get to. But so far, year to date in 2019, there have been 124 IPOs in the U.S. markets. And that number is down from last year, but the dollars raised are about $40 billion, and that's pretty much in line with what we've seen last year. Mm-hmm. So it's going to look this year, when it comes to the dollars raised, that the IPO market is, nothing's really wrong. Mm-hmm. And remembering, too, that this year in 2019, the first 2 months or so of the year, the SEC was shut down, so not much was going on. And then basically we've gotten to this point where we are now facing a slowdown in the IPO market that we'll discuss. So when we look at this year, I think it's not going to appear like there's been any turmoil, but in fact, underneath, there has been. Now, the returns are always the very important thing about the IPO market, and the returns were so strong all the way through the end of July of this year. Mm-hmm. The returns on, as measured by our index, the Renaissance IPO Index, for example, were up almost 40% mm-hmm. through the end of July. Mm-hmm. And after that, we've seen market turmoil that we'll get into, which saw a pullback in these returns, where now the index is up a little over 20% so far this year. So there's been a give back of returns, which have been caused by a number of things, including, as you mentioned, the very poor performance of some of these money-losing unicorns.
Mm-hmm. So you mentioned the Renaissance IPO Index. Could you tell us a little bit about the winners and losers this year?
Yes, I can. When it comes to the index, which is designed to be a 2-year rolling population of the largest, most liquid IPOs. And so they include IPOs a little bit more than just 2019. So 2019 has its winners and losers, but the index itself, the strongest performers have been Roku mm-hmm. company, which is up 200-some% since its IPO. Streaming, and DocuSign has been a strong performer, along with Anaplan. They have been good names. Basically, we're talking about most of the names have been either been subscription-based services that have been our better performers. The losers, on the other hand, have been companies like Spotify, which did the direct listing. That's the number one holding in the index, and Uber, and a biotech named Moderna that has all of the characteristics of in particular, Uber and Moderna are money-losing companies that investors have been shying away from over the last several months. So those have been the winners. In the IPO market itself, the big winners that happened in 2019 include Zoom, and they include other companies such as CrowdStrike and the Beyond Meat. I would say, with the exception of Beyond Meat, which I think has its own special story, the winners overall for 2019 have been the subscription profitable companies with recurring revenue serving the enterprise. And the high-profile losers have been, no doubt, Uber, Lyft,
Right.
Smile Direct.
Yes.
So that's a little bit about the individual names that have added and detracted from performance.
Okay. Yes, companies that have profitable businesses and innovative business models, their share price is going up. That makes a lot of sense. In fact, but of course, this year's winner, Beyond Meat, which is a plant-based meat company, and another winner, which Palomar Holdings, which is an insurance company. That may surprise people a bit. So what do you think are the reasons behind the success of Beyond Meat and Palomar Holdings?
Sure. Beyond Meat basically is a story about the plant-based burgers and the huge demand for this company's product, which is an alternative to meat, and the demand exceeding the capacity of the company to produce. The numbers, they were not making money, but were projecting to be profitable within the year of its IPO, and we saw the company land a lot of contracts after the IPO was completed with major fast food, quick service restaurants, and they recently landed a contract with McDonald's. And Tim Hortons came on board. So it was all about these contracts being signed that happened after the IPO traded, and then the capacity, the demand exceeding capacity. So that was, I think, a unique story. In the case of Palomar, another unique story, this company provided earthquake insurance, and market that has been growing, and the existing competitors in the market were not keeping up with the growth. So an underpenetrated market, and a company that was using some interesting intelligence on how to write better insurance policies. So another unique one, which are often some really good ones to try to figure out when you're looking at IPOs.
Right. So let's talk a little bit about some of the high-profile losers, mainly Uber and Lyft. And I recall that when we discussed these companies before they made their public debut in March, you did mention that valuations look high, looking at their business model. So tell us what went wrong in case of Uber and Lyft, because their share prices are trading significantly below their IPO prices.
Yes. Well, at first, I think investors were very cautious about these, and the stocks did not do well in the beginning, but it wasn't too bad. I mean, it looked like maybe once the companies began reporting their results, that investors might warm up and understand what the vision was, because clearly the vision wasn't reflected at the beginning in the trading. But that didn't happen. Investors didn't get more comfortable with this, and I think it's because the marketplace over the months leading up to now has started to become much more risk-averse because of worries about recession and the weakening economy. So there's been a risk aversion. Lyft went through its lockup release and continued to trade down. The stock is now down about 46% from its IPO price. and Uber is about to go through its lockup release. So I don't see any release on Uber till we get beyond that period. So, and then we had, and I think many were surprised to see that Smile Direct did so poorly.
Mm-hmm.
And that was another company with negative cash flow beyond any years that we could project. And so that one has been challenged, and that relies also on financing its new customers. So there's a financial aspect to Smile Direct. And even Peloton, which people love this service, and I think can understand maybe a little more about this path to profitability. Peloton also has not performed well because they were losing still on $1 billion in revenue, $200 million of losses. And again, the risk aversion in the marketplace has investors really very cautious about these companies. So we've just been seeing this play out in the market and kind of get to the point we are right now. Mm-hmm. And the point we are right now really is the market is pretty much, it is just about closed for any company with those profiles.
Oh, wow. Yeah, and any discussion on the IPO market has to include WeWork, which had to shelve its IPO plan. But, the company is kind of a poster child of what went wrong with some of these unicorns. Adam Neumann, the founder, there was some crazy stuff reported by the Wall Street Journal that he wanted to become the leader of the world. He talked about living forever and becoming the world's first trillionaire. And he actually made himself a lot of money. He sold shares, took out loans against his equity stake, and he and his wife purchased some of the priciest properties in the country. But the company may not be profitable for a long time or forever. WeWork lost close to $2 billion since the beginning of last year. And Adam Neumann's share were worth 20-1 initially. The corporate governance was so bad. The company, which was valued at $47 billion at its most recent private funding round, could in fact be heading towards bankruptcy. So tell us about your thoughts on WeWork.
It's an incredibly sad story, but it's not the only time we've seen this, and we'll see it again. I think that this one has devolved so quickly just because the losses have been so large and the valuation so large, and then the excesses in terms of the governance. And, our feeling is that it's good to see public investors reject this kind of setup because it tells you the IPO market is working. There has to be, the IPO market has to resolve this, the valuations, and it's the place to do it. But I would say the result of this and then these other poor performing IPOs that kind of look similar in many ways in terms of losses and high valuations, it's a wake-up call to the many, many other companies that are targeting going public. A company that can have this governance structure and do these sorts of things means that the board is not really working the way they should to advise the company to make sure they're ready for sort of the seriousness at which a company should take its new investors and what it needs to do. So these companies have been totally unprepared. It's not the first time we've seen it. I believe the Snap IPO performed poorly because of many of those factors. Mm-hmm. So I think that the companies, they have private investors, and those that are on the boards, it's incumbent upon the investors to make sure that they help their companies to get together a structure that'll be appropriate for being a public company. So, and I do believe that this is going to be, it's going to resonate for all the private companies now that are sitting there, because when the IPO market is shut for this kind of company, that is a liquidity scare that emanates through the private markets. And when the IPO market is not working, an avenue of liquidity has been shut off. That is not a good thing and should be, and I'm sure it's of concern to anyone who's in private and been expecting to find liquidity in the IPO market. To find that market is shut is going to cause some troubles for companies that, if they need capital, they're not going to be able to raise it easily.
Okay. So do you think the IPO party is over? Because in addition to WeWork, entertainment group Endeavor also pulled its IPO, and you mentioned liquidity scare in the market and risk aversion among investors. So do you think other startups will be more careful about corporate governance, or you think that investors will remain cautious of IPOs going forward?
Well, one thing I should mention is I just don't think that these issues fall at the doorstep of some of these large ones that we've mentioned. I mean, clearly that's a category overvalued, money-losing companies with maybe out-of-control management or management that's not really respectful of shareholders. But it also relates to the fact that we've had some risk aversion in the market. So many of the companies, the darlings of the enterprise software area, their multiples have contracted over the last couple of months. So their stock performance hasn't been too good. So once we saw this and we use our index, you can tell from the index that as long as it stays disconnected and underperforming, which it has been over the last couple of months relative to the S&P, the IPO market is not going to work properly until that index turns into positive performance. And then investors are going to look again. And our experience tells us that this can take some months, and we think it's possible to have a very slow IPO market, if not certainly the window shut for many companies between now and the end of the year until we see an improvement in the performance of the ones that are already out there. So I would look at our index as a signal that when the market might be open. But we think it'll be pretty selective right now.
Okay.
On that point, the market, we do have a deal that's moving forward, and it's kind of a perfect deal for this kind of IPO market. And this is a company called Bellring Brands. And don't be confused about the name. It is a spinoff of Post, and this is a company that makes power bars. It has $800 million in sales. It's a consumer staple. Okay. And that is exactly this kind of conservative company with 22% cash flow margins and a price earnings multiple of 18 times is the kind of company that is likely to be well received in the IPO market in the current condition that it's in.
Very interesting. So I wanted to switch gears a little bit, and I wanted to ask you to explain how the IPO process works, because I don't think many investors understand the details of the process. So could you explain in brief?
I can, and I'm thinking that this is coming up because there's the contention that maybe direct listings might be an alternative to underwritten IPOs.
Right.
So essentially what an IPO is when and a company is private, they need to typically raise capital. Some maybe not because they're cash flow positive. Maybe they don't need to raise capital, which may be the case of Airbnb. And what you'll do is an investment banker will advise you. You'll come up with what you think is an appropriate public valuation for the company by comparing your company to other peers, and not making the mistake of looking at your last private round, which clearly has not been appropriate for many of the companies that have made that mistake. But basically, you'll look and say, what is the valuation where I fit into the rest of the universe of other public companies? And then you would sell a portion of your company at that valuation into the two public shareholders, who primarily these days are institutional investors, not so many individual investors. So you have kind of a smart group of investors. When it's an underwritten process, the underwriters will put a discount on the IPO with the view that not about the first day of trading, but about making sure the IPO price does not break stock trading does not go below the IPO price in the months following the IPO. So it'll look like there's money left on the table, but in fact, it's meant to be a price that enables the company to go through some market turbulence and not go below its IPO price. There's been a lot of a push to have companies do direct listings by eliminating this underwritten process and not leaving any money on the table. There's a perception that the IPO discount is leaving money on the table. I would argue that one should look at that carefully about what that means. So the direct listing is a way to put shares into the market. You need to be a company that's not raising new capital, and you put your shares into the market at a price that may make sense based on what maybe a handful of institutions are willing to start out trading with. This structure also does not have a lockup. An underwritten IPO has a lockup, meaning insiders cannot sell typically for 180 days. There's a lot of value to the IPO lockup because a company's shares, if they trade in the market for a while and once they've reported earnings, investors, the market understands them. And I think without a lockup, it's a lot easier to fool the market as to what you're all about without demonstrating some performance. And it seems only right that insiders should not be selling during that time. They should wait until the company's stock is established and some results have been reported before others are able to sell. That's sort of the concept. But in order to maximize price and sell as soon as possible, this direct listing is being promoted by, of course, those who are private investors who want to get out as soon as they can at the highest price. So we have a little bit of a market debate over this point on should all companies do direct listings and eliminate that first day pop and stop that unfair IPO lockup.
Right. Okay, that's very interesting. Let's talk about your ETF now. It's the first one is the Renaissance IPO ETF with the ticker IPO. And this was, in fact, one of the top performing ETFs earlier this year. And of course, the performance has suffered because of all these high-profile failures in the IPO market. But I think it's still beating the S&P 500 year to date. Tell us a little bit about this ETF and the top holdings that you like.
Sure. There are some important things. We've been involved with the IPO market for a long time as a research firm and in asset management. And when the ETF structure came out, we looked at this and said this could make a lot of sense to structure the ETF and design it to try to avoid some of the losers. And I try to structure it so that we can get factors that make it your chances of doing better with IPOs are based on those factors. And one of the really important factors for IPO investors is the larger IPOs tend to outperform the smaller ones. Even though I know we're talking about some high-profile failures, really, when a company's larger, it's more liquid and it tends to be more established. And so, if you weight your portfolio based on market cap, you then get the heavier weight to the larger, more liquid IPOs. So we structured the portfolio to do that and to also get exposure to companies that aren't yet put into indices, and that's why it's a 2-year rolling population. Major indices, for example, the S&P, did not include Facebook for 2 years after Facebook's IPO.
Right.
And there's alpha in these companies early on that we felt we could get the IPO effect in this product. So that's why we have this 2-year. That's why it's market cap weighted. And, some of the other issues with IPOs are when to trade them. It's a very emotional category of equities and very hard to time correctly. Mm-hmm. So having a rules-based buy and hold portfolio kind of takes the emotion out of the investment process, and it reduces single stock risk. Mm-hmm. The other thing about the ETF is that trading IPOs can be costly, and all with taxes and commissions. And so within the ETF, you get a much more a low-cost portfolio, particularly our international one, where we're holding names that are trading in foreign markets. So it's very cost-efficient for an investor to own that product. And through the in-kind transactions of an ETF, you're able to minimize taxes at the portfolio level. So the ETF's a very good structure. And in our ETF, we are able to offset fees for investors by lending shares that are in the portfolio to short sellers. Right. So, for example, Beyond Meat has been one of the favorite, most profitable stocks to lend, and we are a holder of Beyond Meat and have made good money for our shareholders in lending that stock to short sellers and a few others, including Uber. There's a list. So we think the index rules set up this way kind of help change the game for IPO investors and make it, easy for an investor who's a little challenged with, deciding which ones to buy. That's the institutional job. They can do that, and individuals that want exposure here can use our product. Really, some of the favorite names in this product, it's the diversification that I think is great. We've always liked when this year's IPO, when Zoom Video came public, that profile of the company that it was disrupting the video conferencing business, a subscription model, targeting enterprise, and growing so fast with good recurring revenue, and that's in our portfolio. Roku's been a favorite of ours. That's been a good performer. Anaplan is another company that's an enterprise-based, one that looks a little bit like Zoom. So those are the companies. And I guess, since it's a rules-based company, we are owning Uber, Lyft, and there will be a time when those companies will find their valuations. Right. and also, as the IPO market corrects, which has been doing now, the new ones coming out, as I mentioned, the ones that are already trading need to recover before the new ones come out. So when our IPO index turns, it'll be a good place to be, as will the IPO market and these new names that come out following that turnaround in performance. Generally, when the new companies come out after a correction, they tend to be the most attractively priced, higher fundamental companies because investors are so cautious coming out of a correction like this.
Let's talk a little bit about your international IPO ETF as well. It's the Renaissance International IPO ETF with the ticker IPOS. Tell us a little bit about the ETF and its top holdings.
Yes. Well, this ETF is still a fairly small product, and yet it's had some very good performance. Not as good as the U.S., but the international markets have not been as strong. The returns have been better this year and we compare this to the MSCI, the ACWI, ex-U.S. So it's an MSCI non-U.S. index, and the performance has done well. The holdings include, again, the largest, most liquid IPOs that have been done in the last 2 years. It tends to weight itself to, we have a large weight in Hong Kong. We recently, for example, just included AB InBev, one of the largest IPOs this year, which is the Asian beer division of InBev, the faster-growing business division of InBev. Some of the names, the top names include Meituan Dianping, SoftBank Mobile, China Tower, Xiaomi, the phone manufacturer there. Those are all Asian companies. But also we include Adyen, which is a processing company based in the Netherlands. We have Siemens Healthcare, which is a German company, so Germany too. So the idea is the same as the U.S. one, and that is to include the largest, most liquid, So it has a large cap orientation, especially the international one. Companies that are not yet included in major indices. And it tends to be where the issuing markets are more active and liquid, and they include Hong Kong, Japan, Germany, and we also have some Brazilian and Indian names in the portfolio. So the results have been very good, and it's a newer product. It's been less than 5 years in the track record, so we're building a track record in it now.
Mhm. Yes, both of them are very interesting products, and I agree with you that for investors who are interested in IPOs, an ETF structure makes a lot of sense because these newly minted companies are quite volatile. There would be some very big winners, but some big losers too. So that's all we have time for today. Kathy, thanks again for joining us.
Thank you very much. Nice to be on the show today.
Thanks for listening. If you want to learn more about these IPOs and the IPO ETFs, please visit renaissancecapital.com. Make sure to be on the lookout for the next edition of ETF Spotlight and make sure to subscribe. If you have any comments or questions, please email podcast@saks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.